Hello everybody, Brian here from quantlabs.net. So today I want to show you the portfolio optimizer with Sortino ratio. Now first of all, I'll be working off of this video of the new data set and corrections from the previous videos I put out. Forex currency, Forex pair, volatility, long and short term. So using that data and calculating which one are the more volatile currency pairs, I've gone ahead and wanted to run this portfolio optimizing script that I've got. We know about Sharpe ratio, but I've also included the Sortino ratio. And what this does typically is to it's like the Sharpe ratio, but as it says here, differentiate harmful volatility from overall volatility. So it's using standard deviation of negative asset returns, called downside deviation. So I've created this new video, and hopefully, or so this new calculation, hopefully it's working. I posted the query to my Facebook group, so hopefully Sortino's okay. But let me just show you in the meantime what I've got. So what I've added was, if you look at the volatility of these let me just see here, yeah, my ranking. So if you watch that previous video, you'll notice here that I've got listed the Rand and Rand, Japanese yen, the US dollar, and Mexican peso as the two most volatile. So two clarifications here. The previous portfolio optimizer I used was sort of, let me just get rid of that, was pretty well used to calculate the data of 11 months of 1 minute bar data. So what I've done instead was to use just the week's worth of minute data, just to shorten down that analysis. So that's the other big difference between what I'm showing you here. So what we have here is we have the two most volatile ratios, but I'll just show you what I mean here. So the first one is a document that I've created, and essentially, again, this is the first version of this. So what we have here is we've got our two volatile currency pairs, Rand, the yen, and the US dollar and Mexican peso. So we have our average in here. Now, as I expand out, what you'll find is these typically you want to be positive, right? So let me show you the difference if I use the top 5 volatile. So we have here the covariance returns and the different strategy portfolio mixes using these different portfolio percent of weighting. So we have our optimal weights here, as these are our optimal weights for this expected Sortino. Now I want you to understand there is an expected Sharpe, but because these are supposed to be volatile, I'm trying to calculate the Sortino to smooth out the volatility. So here we have 0.042, minimum variance portfolio, long only. I believe that's supposed to be short. 0.42. Then we have a mix of of long short, 0.42 again. And that's the Markowitz. Yes, we got a bug here. Okay, so we have minimum variance portfolio of 0.42, and now this is supposed to be long short. Just so you know. So that's 0.42, 0.042, and then we have the Markowitz long only, 0.42, might be a bug here. No, actually it's 4.19. So this one, the long only, looks like the better. See, Markowitz market neutral, 0.44, so it's 0.042, so this is lower. We have a Markowitz portfolio market neutral, and we also have here the expected Sortino 4.19. So in this case, it looks like the long only, minimum variance portfolio long only, using these optimum weights for position sizing may be, or the weighting might be the most optimal, which gives us hopefully the highest expected Sortino, again assuming that the Sortino calculation is correct. So that's just the two most volatile. Now for comparative purposes, I have here all 5 of the most volatile, and again, when we go back as displayed in the previous video, we are referring to these 5, depending upon my period that I'm using. Remember, I'm using daily, but usually they're pretty consistent, as we identified in the previous video. The top 2 are usually consistent throughout the day. But we're also now including the New Zealand Canadian dollar, New Zealand Swiss franc, and the Australian Swiss franc. Let me just confirm that. But, okay, so let's check it out. One thing I want you to be aware of is when you look at these returns here, so we have, actually these are what I'm assuming is the most volatile, but we'll go with this obviously. So we're now including the British pound and the Swiss franc. So here's the dilemma. Now again, remember, this is using the last week's worth of minute data. So in our case, we have a few negative average returns here. So we have the Mexican and the Canadian dollar. Now we're just going to focus on the expected Sortino. No, we don't have the Sortino here. Okay, let me just see what we got here. Okay, so I'm gonna have to make a correction here. I'm gonna pause the video and come back. Hey all, welcome to my next segment here. Okay, so what we've got here is a situation where we have our 5 most volatile, the Rand, Japanese yen, dollar, peso, New Zealand dollar against the Canadian dollar, New Zealand dollar against the Swiss franc, Australian dollar against the Swiss franc. Now, here you can sometimes get average returns. Now remember, we're only using the past week, so I just want to show you a comparison between these two. And if you were to just trade only the top 2 volatile or most volatile, and then the if you were to add in all five and see what kind of expected Sortino, if it's correct, we can expect. Okay, so here's our returns, expected returns. Now, one thing I want you to understand here is, yeah, I'll show you in a minute. Okay, so we've corrected this. Long only, minimum variance. Here's our expected Sortino, again, assuming if it's correct. Long short, 3.034. So going long is going to be better. Then we have the Markovitz long only, 0.0455. Long short for Markowitz. So long short at 0.047. And then we also have the Markowitz portfolio market neutral at 0.41. So essentially the highest, if we went using the Markowitz, I believe it was the Markowitz long short, sort of here. So these would be our combined weighted average, optimal weights. Now, if we go back to compare these against our other, let's see if we can get, we want our most volatile, which I'm assuming would be this one. Wrong program. Okay, so let me just load up our next. So we got our two most volatile. Okay, so if we do a side by side. Okay, so here they are. The again rand against the yen, and then the U.S. dollar against the peso. So if we again do a side by side comparison, we know that if we did that Markowitz portfolio long short, this is the highest expected Sortino we can get using that particular strategy. So let's see if our top two most volatile only will give us a higher expected Sortino. So just wait it out. So 0.42, no, 0.41, 0.41, 0.204. Okay, so it looks like as it stands, if we were just to go with the top five, we may be able to get a higher Sortino using this mix. But then I guess what we could do is we could just do looking at the code here. Say you want, okay, so I'm going to just do something kind of crazy. We do the top three only, and we beat that Sortino of 0.047. So let's do that. And here, so we have portfolio optimization. So it was a long short, yeah. So save this as 5. Okay, so these are the 5 here. Let me just so we don't care about this. We care about ODT. Hopefully that format will work okay, which I think it did. Okay, so if I remember, we had set it at 3, so let's go ahead and run that. Okay, and then we will rename this file to 3 for 3 assets, 3 more volatile. So let's see what we get here. So again, we're trying to beat this 0.047. So let's see if we can get, where's our point? So, okay, we want this one. Where's our 3? Huh, doesn't get loaded in for some reason. Okay. See if I can do a preview. Okay. So let's look for our 0.047. So again, what we're looking for is any strategy mix of 3 most volatile or most 4 volatile will beat this 0.47. So let's see if that's the case. Okay. Which one's the preview? Okay. So our expected Sortino is very low. So you can see here, this average return is too low. And that really distorts these Sortinos quite a bit. Here's one at 0.04, 0.04, 0.04, not enough. Okay, so let's just add the 4th one in, the top 4. Here. So we want the so take this, comment that, make it the 4 most volatile. Let's see if this works. Okay. So here's our new document. Preview. So we want to beat 0.047. Okay. 0.026. So you can see here is our top 4 average returns. 0.2026, 0.006, 0.4041, 0.044, 0.041. Okay, so what I'm seeing, oddly enough, is this has the highest expected Sortino with all 5. So that's pretty interesting. And with a heavy weighting on the Australian Swiss franc. Interesting to get that highest expected Sortino. So the question becomes, well, do we simulate that? And obviously, there's going to be a lot more analysis on historical data on that. Hopefully, you get this, and thanks for following through on that. All right, later. Hey everybody, we got the new corrected Sortino ratio. So let me show you the volatility of the currency pairs have not changed. The only difference is that the Sortino is assumed to be correct. So what we'll do here is I'll load it up, just ran it. So here we see we have the, actually, let me just rerun this. It should be against, no, okay, so I have to make a correction here. Okay, so what we want to do is, where's our code? Okay, so we're going to take this out. I'm going to uncomment this one. So that's all 5, the most volatile. So I'll recap this once we get the report. Okay, so here's our first one with the 5 most volatile. The currency pairs that we are referring to, again, Rand against the Japanese yen, US dollar against the peso, New Zealand dollar against the Canadian, New Zealand against the Swiss franc, and the Australian dollar against the Swiss franc. So what we're going to do here is we're going to look for any Sortino that has a higher, so we have here, I'll just make a note here. So if we have all 5 portfolios, the highest one that will give us the highest is Markowitz, long short, or long only, it looks like. Long only, actually long short. So that's again the 0.0476. So that's the highest expected Sortino I've seen. Okay, that's fine. So this means the all five most volatile currencies. So if I go back in the code and only run the, let's say this one, the top 2 most volatile, let's see if we can beat that. Okay, so let me just pull that up again, just do the preview. Let's see if we can find anything that beats 0.47, 0.42, 0.41, 0.41, 0.041. Nothing beats it, but you can see here that the averages are still positive, so nothing beats that. Okay, so again, I have a funny feeling that if I add the New Zealand Canadian, let's see what that will do. Okay, so still want to beat that 0.47. All right, so we have now 3 assets, 3 currency pairs. They're still positive for the average returns. 0.41, 0.41, 0.40, 0.041, 0.022, no way. So if we do the 4 assets, which in this case would be this one, let's run that. That's fairly crude testing, I know, but we can easily automate all this stuff. We're just testing it, see what happens. Okay, so the preview, what we got here. So these are the four most volatile. Do we beat that 0.047? Nope. 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 But again, Markowitz portfolio long short. So it looks like our strategy with all five and the Markowitz long short, it has the highest expected Sortino. So let me just run that again, just as a confirmation. So we are running this one, and see if all the average returns still remain positive. Okay. So from what we're seeing here, we got okay, here's all five. So all the average returns are positive. So the long short is 0.047. Okay. So that's probably the best we can get. Okay, hopefully I'll help you out, and we'll talk to you later.